Hello, doctor. My name is BanYuanyuan, and this is my presentation of time series analysis assignment. In first case, I choose option 1 to study. I collect quarterly data on real personal consumption expenditures per capita and real disposable personal income per capita for the United States from 1960 to 2020 from FRED. First is about the trends and potential analysis. As can be seen from the scatter plot, as income increases, consumption also increases simultaneously, but the income level is always higher than consumption. And the linear graph shows that in 2020, affected by the COVID-19, both income and consumption have experienced more obvious fluctuations. From the scatter plot, it can be observed that the point distribution between income and consumption shows a linear trend, which indicates that there may be a strong contiguation relationship between the two variables. In order to conduct the Johansen test, I first conducted a unit root test on the consumption and income to determine the stationarity of the variables. First, the figure of the unit root test for cons shows that consumption shows that the t statistic is 0.149887, which is greater than the critical value, while the p-value is 0.9688, which is much higher than the 0.05. This shows that we cannot reject the hypothesis. And I do the same test on income. From figure, I find that the t-statistic is 1.768996, and the p-value is 0.9997, also rejects the non-stationary hypothesis. Therefore, the two variables needs to be further differentiated to test its stationary. So I conduct the unit root test on the first order differences of the two variables. And we can see the t-value is all less than the critical value of the significance levels, and the p-value is 0. And we can reject the hypothesis. To sum up, both variables, income and consumption, are I1 sequences. And then I first use the VAR model to determine the number of lags. From this figure, we can see that the third lag is optimal lag order for the VAR model, which based on the selection of the most criteria. Secondly, I selected the lag order of 1 to 2 to run the Johansen test to confirm the contiguation relationship between the two variables. And finally, let us take a look at the results of the contiguation test. As can be seen from the trace test results, the trace statistics is 38.55563, the more than the 20.26184. The non-hypothesis of no contiguation relationship is rejected. The p-value is 0.001, less than 0.05. It can be seen that there is at least one contiguation relationship. In addition, as a 0.05 significance level, the non-hypothesis of at most one is accepted, indicating that there is no second contiguation relationship. As can be seen from the maximum eigenvalue test results, it also supports the existence of one conjugation relationship. And then I'm using the FMOLS to estimate the long-run equation. First, determine the general form of the configuration equation as follows. Secondly, enter the equation form in eViews and run the FMOLS method to obtain the results shown in the figure. And estimate the long-term equations as follows. The regression results show the coefficient of income is 0.936, close to 1, and the p-value is 0, indicating that the income is the main driver of consumption growth. And it can be seen from the R-square of 0.991. It can be seen that the model fitting effect is good and explains more than 99% of the consumption changes. Similarly, I entered the equation form in eViews and ran it using the DOLS method to get the results shown on the left and estimated the long-term equations as follows. The results shows that the coefficient of income is 0.9848, close to 1. The t-value is 113.91, and the p-value is 0, indicating that the impact of income on consumption is extremely significant, and the fitting effect of the model is excellent. The Johansen test has been used above to verify that there is a configuration relationship between the two variables. Next, I will use a configuration equation in eViews to calculate the residuals. Generate a new variable and name it as resid 01 and use OLS to estimate the error correction model. The results are shown as a left figure. Based on the analysis results of the left figure above, I constructed the ECM model as follows. From the long-term equation, we can see that the coefficient of income is 0.936327, which means that for every 1 unit increase in income in the long term, consumption will increase by an average of 0.936 units, and the p-value is 0, indicating that this coefficient is highly statistically significant, and income has a strong positive impact on the consumption. The R-square value of the model is 0.9913, indicating that the model fitting effect is excellent. The results shows that changes in consumption are not only closely related to changes in income, but are also significantly affected by past error adjustments. Negative coefficients may reflect short-term economic fluctuations or the complexity of consumer behavior in the short term, such as an increased propensity to save. And in the second case, I chose option 2 to study. I collected daily exchange rates for the pound against the US dollar and the euro against the US dollar from Yahoo Finance. From the linear graph, we can see that the overall trends of GBP/USD and the EUR/USD exchange rates are similar, both showing periodical fluctuations. From the scatter plot, we can observe that although the data shows large fluctuations, it still shows a certain concentration distribution, indicating that the two exchange rates have a certain correlation at specific points. As can be seen from the scatter plot, the data points of GBP/USD and the EUR/USD are basically distributed around the diagonal line, which may indicate that there is a conjugation relationship between the two in the long run. This is further verified from the linear graph, and the long-term change direction of the exchange rate is consistent. Now first, I conducted a unit root test on the GBP/USD and the EUR/USD to determine the stationarity of the variables. The figure of the unit root test for the EUR/USD shows that the t statistic is minus 2.185806, which is greater than the critical value, while the p-value is 0.2117 is much higher than the 0.05. This shows that we cannot reject the non-stationary hypothesis, and I do the same test on the GBP/USD. The result is the same. Therefore, the two variables need to be further differentiated to test its stationarity. So I conducted a unit root test on the first-order differences of the two variables. From the figure, we can see the t-value is all less than the critical value of the significant levels, and the p-value is 0.0001, and we can reject the hypothesis. To sum up, the results indicating that both variables are I1. From the previous analysis, we know that EUR/USD and the GBP/USD are I1. Now we can perform the angle grandeur test. The first step is to test the conjugation relationship. First, I conducted the following equation with EUR/USD as a dependent variable and performed the OLS regression use eViews. Secondly, I extract the residual sequence from the regression results as resid 02, which the dependent variable is EUR/USD. From the results of the unit root test for resid 02, we can see that the null hypothesis is rejected. Then the p-value is less than the 0.05. So the residual is also stable. Step 2, build the error correction model. First, I generated the lag term of the residual in eViews. Then we construct an equation as follows. From the analysis results in the figure above, we can see that the coefficient of the resid 02 is negative, and its p-value is 0.0232. This indicates that it is significant, which shows that the model has a long-term equilibrium relationship and the system will gradually return after deviation. Finally, the regression equation can be established as follows. The regression model shows that the coefficient of the GBP/USD is 0.4688, which is highly significant, and indicating that there is a strong positive linkage between the two. At the same time, the coefficient of the lagged residual term is minus 0.003572, which is less significant, indicating that the EUR-USD exchange rate will gradually adjust after deviating from the long-term equilibrium, but the adjustment range is small. The results suggest that the exchange rate fluctuations between the euro and the pound can be driven by common economic factors, such as the trend of the US dollar or the economic ties between the euro area and the UK. At the same time, the adjustment mechanism of the lagged residuals reflects the characteristics of the exchange rate tending to equilibrium in the long run, but may be affected by market sentiment of external shocks in the short run. Okay, this is my presentation. Thank you, Doctor.